given these possibilities ahead. I think the most likely case, and we're already into it, is the Fed keeps the money pump going on the excuse of unemployment or on the excuse of this or that. Or they might just come out and say, all right, we've shifted our target to 5% positive inflation, and then, excuse me, I'm sorry, it was 8, okay, next year we raised to 6 and it's 10. And, basically, we start heading to the hyperinflations of Latin America of the 1970s and 1980s. How far does it go? It was not unusual to have 1,000% inflation in those countries during those years. 1,000%. Now, what are you going to do as an investor in that environment? Well, anything you hold in the way of fixed income is torched. Anything you hold in terms of U.S. assets is torched, and it could be equity. And you might say, well, equity is somehow benefits from this, the revenue stream increases, but it doesn't work that way because the discount rate of future earnings is so large. It doesn't work that way. In fact, you want to take a look at equity markets. The equity markets for the last 10 years in the U.S. have been pricing in the deterioration of our status relative to the developing countries. This starts in the year 2000, so it's 11 years. Now, admittedly, we're starting the benchmark at the peak, and it was the peak of the tech boom. I'm not sure if it was the year end or beginning of the year. I feel a lot better if it was the year end. But all the indices, in real terms, are down 29%. I'm not sure if that'd be in green. That's the Dow. The S&P is down 43 in real terms, and the NASDAQ is down 63 in real terms. So basically, this is just reflecting the competition from abroad and not the inflation. If you remember the 70s, on top of that, the PEs went down to 7 in the market, and for good reason, and part to all my students who are still here, we'll get to that in the last week of class, why the PEs go so far down in inflation, but they do. Capital flees. So the question becomes, where do you as an investor look to weather the storm? And it's obviously not in U.S. assets. It's absolutely not in fixed income. Equity buys you nothing except pain as well. So you're going to have to start going to foreign currencies. Now, there are two good reasons to go to foreign currencies. One is just our own sovereign problem, and the second reason is the inflation problem. They reinforce each other, and we've already seen it this past year, and with QE2 started, beginning of the monetization, this is the growth of different currencies relative to the dollar. The Japanese yen, I believe that's what this is. These are appreciations of currencies relative to the dollar. The other thing that appreciated relative to the dollar is gold and silver, as it should. And this is gold and silver up here, and these are both the European stock index and the S&P 500. So when you start getting to an inflationary environment and a sovereign risk is the first cousin of inflation. Or inflation is the first cousin of sovereign risk, because that's how you ultimately deal with it. So this is the metals, the precious metals, in the last, since QE2 started, and this is the stock indexes, both Europe and here. So obviously, you're looking for commodities, you're looking for foreign currencies. I have a few others. On my last blog, China ends up being the winner of this game. This is yuan deposits in Hong Kong banks. And this is all as a result of the sovereign risk problem. It's going off like a rocket. And one of the currencies that it's appreciating is the yuan. And this is the path of the yuan. So there aren't very, some of the currencies have doubled back, like the Swiss currency has doubled back because of intervention by the central bank, because they didn't want any more appreciation so they could sell skis next winter. And that could happen. But basically, the possibilities are more broad, and you have to be a lot more adept. Lots of times, by the way, the way to be, I guess here's my message. I teach in the finance department, and the conventional wisdom has been what? Diversify stocks and hold for the long run, and maybe throw in a little debt. And maybe in the last decade or two, maybe throw in 10% of foreign stocks. So diversification. Now, during the era of the 60 years when we grew steadily, only interrupted by a few short recessions, that worked. it gave you the market return with a little less volatility if you diversify. So that's what you got out of it. Guys like, you know, the guys who put out the index funds, they just say buy the index. You know, don't even bother with the diversification, just buy the index. But the index is not going to do you any good. Diversification on U.S. assets, debt and equity are not going to do you any good, because what you have to do is now look at diversification in a whole different context of which currency, which country, which currency, whether to be in real assets versus financial assets, whether to be long, whether to be short.